On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Jeff Blazek. He is the Co-CIO of Multi-Asset Strategies at Neuberger Berman. Jeff, the Asset Allocation Committee at Neuberger Berman has been broadly positive on equities. What drives the optimism, though, especially in the face of ongoing interest rate volatility and, say, global growth, slowing global growth data?
Hey, Todd, it's great to be here, first of all. And yeah, we are constructive. We did upgrade equities back in April, which, as you can imagine, was a bit of a harrowing call at the time, considering we were in the teeth of Liberation Day. But we saw a lot of positives around the sustaining of above trend economic growth, strong earnings, stimulus on the table once we got through the tariff noise. And while there today, now that we've had a 35% plus recovery in the S&P, we certainly need to take stock of it, and we continue to like risk assets, but we do think there's going to be some divergences. So look forward to getting into some of those nuances with you.
And you did touch on the performance. Obviously, it has been overwhelmingly positive. I would think it's exceeded everyone on Wall Street, all analysts' expectations. But we've seen a big run up, particularly recently this quarter, mainly because, well, very recently, is because the end of the government shutdown, but also the interest rate stance from the Fed. What do you think is attributing to the rally, though? Do you think it's based off a sentiment, or do you think that there's more on the fundamental earnings strength side?
Yeah, look, first of all, we're happy that the shutdown is behind us. That's going to be a positive. That's giving investors comfort. But this is being driven by a couple of things. First of all, fundamental strength in earnings, acceleration in a lot of cases in top line and bottom line. But more importantly, it's being driven by perceived strength and sustainability of the capital cycle. And so those investments that are aligned with AI, it's hard, we give ourselves credit. It was 3 minutes before the AI word came up, but it's hard not to acknowledge the fact that it is now contributing about half of the growth in the US economy alone. And when you look at markets like Korea and China that are quite tethered to that phenomenon, it's very clear that the more that you are tied to technology and AI and capital infrastructure spending, the more you've been a winner in the last 3 or 4 months in the equity market.
Right. And we will touch on AI, that's for sure, as we go along with this segment. I do wanted to address, though, the committee's overweight stance on small and mid cap stocks. What signals do you see out there, though, that are going to tell us that companies or small and mid cap companies are going to outperform in the near term?
Yeah, there's several aspects why we have increased our conviction in small cap, and we've been a bit early on that position. We overweighted it a little over a year ago. And the first one is the Fed, to go back to that. So the fact that we've now hit the play button, we're not on pause anymore on the easing cycle, that is going to translate immediately to smaller companies, which have higher levels of debt. They have floating rate debt. So this is real time money that is going to be coming back into profits for smaller companies. Second of all, we're seeing strong sentiment. We're seeing small business owners feeling a little bit more comfortable after we've navigated the worst of the tariff noise. And the third piece around it is major stimulus that is coming in the next 3 to 6 months. So from the OBBBA alone, we're going to have about a 1% juice to GDP in the US in the first quarter. And now, by the way, while there will be some uncertainty around a possible IEEPA reversal by the Supreme Court on tariffs, that could cause refunding of a couple hundred billion of further stimulus into the economy. So that's another short-term catalyst. So when you look at all of these now tailwinds that were former headwinds for small businesses, along with the fact that they trade so much cheaper than large caps, we just think that there's a lot of reasons to be bullish on small caps.
Yeah, that does make sense. So let's turn the page here to geopolitics. So how much does the current trade war and, let's say, elections, how much do you take into consideration with your asset allocation models?
It is a huge driver. It's not the primary sole driver, but when we look at geopolitics, in so many cases, it's going to drive the outlook for fiscal and monetary policy. The fact, for example, just to give you a small micro study of that, we were overweight Europe previously, and we recently downgraded it to at target in part because the earnings had not delivered as much as we would have hoped for, and we're in a bit of a show me mode on Europe. But we also did that downgrade because of the complexities in France alone in terms of their ability to balance the competing needs of a more polarized population and whether they can achieve balance in their deficit relative to some fiscal initiatives and liberating of their economy. So, that's one case study, but geopolitics drives so much of the behavior of our fiscal and monetary policy around the world, and it's a key input.
So, and speaking of on the Europe side, then you went overweight Japan, correct?
That's right.
So what was that reasoning?
So Japan is a multi-year opportunity to us where we got quite constructive on the improvements that they were making in their governance. So we have now, after many years of poor shareholder returns for Japanese companies, despite having so many strong businesses and brands and international channels, a lot of the problem in Japan had been they were not rewarding shareholders and prioritizing margins and returns. Some of that was attributable to the holdings, like maybe these were holding companies or there was a lot of cross holdings. They've cleaned up their capital structures. They put a higher priority on share buybacks. And they now understand, in part from the regulators themselves in Japan, you need to raise the bar on your return on equity. And so when we saw all of those catalysts a few years ago, and it takes a little while for that to get embedded in corporate behavior, but now translate that along with, we do need to navigate some volatility around their currency and rates. But we look at those businesses, they're in the mid-teens price earnings area. We just do think that there's going to be multiple years of outperformance for Japan now that they've addressed a lot of these structural issues.
So I want to go back to the trade war, and clearly we are seeing pressure on consumers. We're hearing news this week about the late payments on autos, and so that's going to obviously balloon up to something that could be much more problematic. With inflation, what is the stance of Neuberger Berman? Is this a just a couple of months scenario, or are you expecting perhaps inflationary pressures further into 26?
Yeah, our fixed income group has been studying inflation closely throughout the year just because it translates into things like Treasury inflation protected notes all the way to the outlook for the Fed. And our bottom line is that we think the disinflation trend was delayed, but it is not derailed. So before the tariffs started, and Liberation Day, to be clear, was far more punitive than we ever would have expected, and that was true for the market as a whole.
Right.
But we looked at a lot of the inputs into inflation, most notably shelter and services, and saw that there was going to be a pretty powerful decelerationary trend in inflation. And maybe tariffs would arrest that for a little bit, but we would get back closer to a 2.5% core inflation rate. Now, Liberation Day was a lot higher, as I said. The headline rate is about 18%, and the effective rate is probably more like 11%. So that is causing a temporary increase. We view it as one and done. It's going to roll through for 6 to 12 months. But
Okay.
inflation has not been as high from trade because a lot of this increase in profit and in prices is being absorbed by the manufacturers themselves. The consumer is only absorbing about half of the cost of the impact of tariffs. And so
Hmm.
what we believe is by the time we get to the early part of next year, we're going to have a two handle on core inflation again. That will give the Fed the backstop they generally need to be at least at a neutral rate or maybe slightly accommodative.
So you think the 2% target is realistic, and that's I would think is an exclusive because I have not heard that with many of the experts that we have on these shows. So with that, then obviously the Fed meeting on December 10th, they're going to cut. But how much further in that easing cycle do you see the Fed going into 26, particularly since you're going to have a change in leadership with the FOMC?
Yeah, just to clarify on the headline, so two handle would mean we could still be at 2.8 rather than the 2.0 target. But, and
Right.
by the way, there may be a change in the target. Perhaps it's outlived its life a bit to be at a literal 2%.
Okay.
But we are, so one thing I'll say is that our fixed income team is generally, again, the primary originator of our view on the neutral rate. We still put it at about 3.5 or maybe 3.25. So to us, we think the market got a little ahead of itself and too dovish about a month ago where it was pricing a terminal rate getting as low as 2.8 or 2.9%. So we sit here today at about 3.75. We think one more cut. December seems still pretty likely to us. And then in 2026, maybe one or two cuts tops. So, a lot of the reason why we think this is while the inflation trend is coming down in a good direction, we would struggle to say that the economy is stalling. We have nominal GDP and real GDP accelerating, probably getting into the 2.5% area in early next year. That would signal to us that the Fed should not be easing rates. And if we think a neutral rate of 3.5 is fair, then we think it's probably fair for the Fed to just stop there and then reassess. But you do bring up a good point about the composition. It is probably going to be a leadership that's more friendly to the administration. And maybe that causes one or two more cuts beyond what we think the fair value is. But we'll wait and see how that plays out.
So, in your opinion, then like you said, when you're looking at possibly 2.5% on GDP, which is actually a healthy economy, and then you have the labor picture doesn't appear to be as fragile as I think some of the headliners like to say. But with that, do you believe that we should be having rate cuts at this point?
Well, and I do think that the labor economy picture is still fuzzy because we're flying blind right now with the shutdown.
True.
We're all eagerly awaiting when we'll start to get some BLS data again on job creation or destruction. But the ADP weekly data, which is really the only real-time proxy we have, has been sluggish. And I do think that the divergence that we see is that GDP could begin to delink meaningfully from the labor economy. In fact, if you look at the last 2 quarters, GDP is resuming that 2% plus growth rate. Labor is basically stagnant. And if we sustain that over multiple quarters or even years, that is a good thing, which is its productivity. Productivity being driven likely by AI, but other initiatives as well. But the Fed's mandate is technically around labor, not around GDP. And so if they see a stalling job market or unemployment that is beginning to rise, despite the fact we could be in a 2% plus GDP world, the Fed, we think it'll have enough air cover to get down to neutral as soon as possible.
Mm.
It is that is to us the Rubik's Cube of 2026. Because if you look at that, how effective will Fed rates be to help alleviate pressure on the job market? But it could risk stoking inflation or causing a red hot economy to emerge when it was already, above trend to begin with.
Right. And the most anticipated jobs report of the year will be released Friday, December 5th. I'm sure everybody's going to be focused on that, particularly since we haven't had one in several months.
Yeah.
I know we're running out of time here. I just want to get your thoughts on as we close out the year. Are there any areas in the market that investors should maybe take a closer look at that may have been overlooked this year, other than tech?
Yeah, I will say for those investors on this show that have access to private investments, we continue to think that is a compelling area. Now, due diligence is important. Fund selection is extremely important in this area. But if you have the abilities to be committing new capital into areas like primary, buyout, or even better, secondaries, because the valuations on those areas are quite attractive, and you can mitigate what we call the J curve. You can get your money on the ground faster. You get better visibility on the portfolio companies that you own. These companies trade at deep discounts compared to public markets. So
Okay.
some of this is taking advantage of a lack of liquidity in the space, but we do think private equity commands a premium of several percentage points above public markets. And so we think that's the sort of thing when you look back after 5 years, you're going to be pleased with those returns.
Okay. Well, final question for you. You brought up AI earlier. I have to ask you, the narrative over the last week and a half has been about an AI bubble. In your opinion, are we in an AI bubble?
We are getting bubblicious.
Okay.
I like that. There was a bubble gum in my childhood that I loved,
Yep.
but I'm not going to call it a bubble yet because right now it's still being funded in a growth stage, primarily with cash flows that are being earned by powerful hyperscalers. But what we're starting to see is more debt being issued and creeping into the capital structure of these investments. And so the natural tendency we have to think when we talk about bubbles, we all remember .com. It was at the beginning of my career. And if I use an analog of where we are relative to that cycle, and there's differences, I don't want to overstate this analogy, but it feels to us like it's more like 1997 because we still have profits growing, margins are healthy, debt is not being used extensively. It's not like where we are in 1999, where suddenly money is being thrown everywhere, debt is being issued everywhere, and we were on the verge of a pretty significant collapse in valuations. So we're on bubble watch or bubble-licious.
Bubble watch, I like that a lot. And you are right, though, because in 1999, you had all this VC money going into dot-com companies that weren't making any money at all. At least you have with the AI companies, they're seeing some type of cash flow.
Yeah,
So
but
it's
the return on these massive amounts of capex in the trillions will be the big question, probably more in 2027 and beyond, and not necessarily, in the next few months.
Love that. That's a great way to close out this segment. Wonderful, wonderful commentary. So, Jeff, thank you so much for joining me today on the Money Path. Love to have you back early in 26. Want to get your thoughts as we turn into the new year.
Eager to be back, Todd. Really enjoyed it. Thanks so much.
Absolutely. So, on behalf of Jeff Blazek, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up tomorrow at 1 o'clock, I am having a one-on-one exclusive with Jeff Klaus. He is the Chief Revenue Officer at Boosted AI. Definitely want to have to hear what he has to say about the AI sector. So until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.